Maybe you've heard your children or grandchildren, or maybe people in your social network or in your community talk about Bitcoin. We designed this series for people who are 50 and older who simply want some basic, no hype information about this digital asset. In no way is any of the content in this series intended to convince viewers to buy Bitcoin or any asset, digital or otherwise. Our first video covered the definition of Bitcoin and how a lot of investors view the asset. The second video highlighted seminal events in economic history that set the stage for the use of fiat money. It's important for us to understand fiat money so that we can begin to recognize what investors mean when they refer to hard assets like gold or Bitcoin. The video you are about to watch is the third in the series and covers the 2008 housing crisis. Although most of us had no idea, 2008 held significance for another reason. Can you guess what that other reason might be? Welcome to Crypto Unite. In the previous segment in this series on Bitcoin, we went over the historical ramifications after the dissolution of the 1944 Bretton Woods Agreement when President Nixon took America off the gold exchange standard. In summary, from 1971 on, the United States proclaimed that it was moving to a fiat system of money that no longer would the dollar be tied to gold. Long-term consequences resulted from this decision, consequences that are still being played out today in the financial markets. But those markets do not exist in a vacuum. And whether we like it or not, we can no longer afford to look at monetary policy as something that only the ultra-wealthy should be concerned about. Monetary policy, because of this fiat system, affects everyone in the long term. And it's been a long time since 1971. Long-term effects of this fiat system are here. And many of you watching recall some of the notorious years that these effects began rearing their ugly heads. For example, remember the dot-com bubble that burst in the year 2000? It was during that year that the U.S. Central Bank felt it necessary to spur economic growth after many investors had suffered massive losses from that dot-com bubble. So they lowered interest rates that eventually trickled down to working-class Americans. The result? First-time home buying boomed. In fact, prior to this decade, buying a house seemed beyond the average working person's reach. But a new kind of housing loan, called the subprime mortgage, arrived. To stir your memory a bit, a subprime mortgage is one that is riskier for the lender. But people who had never been able to qualify for a home purchase finally were able via these prime mortgage companies. In turn, these subprime mortgage lenders sold these risky loans to investment banks, who turned around and bundled these risky loans in with less risky loans. And then they sold these bundled loans in the form of what were called mortgage-backed securities. Remember those? Investors bought these bundles that looked on the surface to be sound investment products. Their investment monies awarded more money to the investment banks, and they in turn bought more loans from those subprime mortgage companies. Now, to understand this concept, picture one of those plastic boxes of raspberries you buy in the grocery. How many times have you bought what you thought were a beautiful mound of fresh raspberries? But once you opened them, you discovered that there was yucky mold growing on most of the raspberries underneath. More mortgages were awarded for homes than at any other time in American history. And because home ownership rose, so did the housing prices. By 2005, many analysts warned that all the signs were pointing to a housing bubble. So, beginning in 2004, the central bank started incrementally raising interest rates to slow the housing frenzy down a bit. In a 2-year period, the Fed raised interest rates over 12 times, which meant that borrowing money cost more than it did in 2002. In 2004, the interest rate stood at 2.25%. By the middle of 2006, the interest rate for a home purchase stood at 5.25%. But many of those subprime loans carried with them what were called adjustable or variable interest rates, which of course meant that people who had been awarded one of those subprime loans were not locked in or guaranteed to always enjoy a low interest rate. The interest rates could vary. So when the Fed began raising interest rates, many of these people who were already stretched to pay the rate when it was low simply could not pay when the rates rose, and the rates kept rising. They felt the pain first. Then the subprime mortgage companies began to feel the pain and were forced to let go of most of their workforce. As a result, home sales began to decline. But remember, those riskier loans had been hiding under the less risky loans in those bundles identified as mortgage-backed securities. Those investors who had trusted those mortgage-backed securities were sound, began to see those rotting raspberries underneath, and the value of those securities fell and fell and fell. All the while, the Fed continued to report to the American public that there was nothing to be concerned about. Take a look, if you can, at these quotations from the Fed and the Treasury from February 2007 through September 2008. The first quotation comes from Ben Bernanke, who was Fed chair. He said, "The weakness in housing market activity and the slower appreciation of house prices do not seem to have spilled over to any significant extent to other sectors of the economy." Now, look at what that same Fed chair said in May of that year. Quote, "We do not expect significant spillovers from the subprime market to the rest of the economy or to the financial system." Now let's fast forward to the next time he spoke in September 2007. Quote, "It is not the responsibility of the Federal Reserve, nor would it be appropriate to protect lenders and investors from the consequences of their financial decisions." Unquote. Then, in July of the following year, 2008, the same Fed chair said, quote, "Fannie Mae and Freddie Mac are well capitalized and in no danger of failing." Then, in September of 2008, Hank Paulson, Secretary of the Treasury, said to the Oval Office, "We are in danger of a broad systemic collapse, and action needs to be taken urgently to head it off. We need the authority to spend several $100 billion." Were you paying attention to the dates from these quotations made by the Fed chairman and also the Secretary of the Treasury? How was it that in July of 2008, there was proclamation that these mortgage-backed securities were well capitalized, and 2 months later, the Treasury chair tells the Oval Office that if they don't immediately release massive amounts of money to the Fed, there will be a broad systemic collapse? How did we arrive at such an emergent situation in such a brief time? Well, now that we're reminded of the many decades of a fiat system at work, we can surmise that the threat of this broad systemic collapse did not occur during a small window of time. From a macro perspective, it really started the day President Nixon announced that the dollar would no longer be pegged to gold. As we continue examining the history leading to the invention of Bitcoin, can you recall what year I said that Bitcoin appeared on the economic scene? The original white paper announcing Bitcoin was published on October 31st, 2008, the month after the Fed warned of a, quote, broad systemic collapse, unquote. Now, as an historian, I tend to analyze events from a macro perspective. Therefore, I could not help noticing that this new system of monetary trade appeared during such a seminal year. Was it coincidental that this white paper on Bitcoin was published in 2008 when the media had been covering the housing collapse in the US and its subsequent detrimental impact that such a crisis would create all over the world if drastic measures were not taken? Of course, drastic measures were taken, and we're going to cover some of those measures in the next video. But before we do, I need to take a few minutes to admit full disclosure. I was not involved in studying tech or finance back in 2008. My questions about the timing of Bitcoin's first appearance did not begin to dawn on me until 2020, when I began a full-time immersion into studying the melding of tech and finance. As a matter of fact, once I devoted just about every waking minute to studying this phenomenon of digital tech interfacing with the finance industry, a funny memory popped into my head regarding the first time I had heard the word Bitcoin. I remember it was 2011, 3 years after its debut. I bet you won't be surprised to hear that my introduction to Bitcoin was through my son, who was 12 years old at the time. Here's a little background. Now my son's 23 years old, and to this day he trades Magic the Gathering cards. And he had begun his interest in playing and trading Magic cards back in 2010. And by 2011, he had amassed some noteworthy cards and traded them often. And sometimes the trades were with kids overseas, especially kids in the UK. I remember that I was on the elliptical when my son appeared and said it was emergent that I'd get off the elliptical and help him with the transaction he needed to make because there was a kid in England who wanted to pay for one of his Magic cards through a currency called Bitcoin. So I said, what the hell is Bitcoin? And my son attempted to explain it to me that it's a way to pay for things, but you don't go through a bank. Well, this all sounded a bit unscrupulous to me at the time. And I said I didn't know if that sounded legal. Well, he assured me that it was fine and that the British kid was willing to trade him 200 Bitcoins for a Magic card that was worth $100. I told him I didn't understand. Why would this guy give my son so many Bitcoins? And my son said, well, Bitcoins are only priced about 50 cents. So, Mom, 50 cents times 200 is equivalent to $100. So I said, oh, okay, well, but you know what? I still don't get it. But let me finish my workout and you can explain it to me a little later. Of course, he was frustrated with me, but that was par for the course after all. He was a 12-year-old. I remember getting off the elliptical and thinking a little more about my son's predicament of not being able to sell his Magic the Gathering card to the kid in England unless he could accept Bitcoin as payment. So parental guilt set in, and I decided I should try to listen to my son. I remember walking down the hall toward his bedroom, and I remember him meeting me halfway in the living room. It was there that we had a conversation about this thing called Bitcoin. I asked him how it worked. He tried to explain it to me, but it sounded so strange. I couldn't really understand him. He said that Bitcoin doesn't go through a bank, which confused me. And since he was a 12-year-old, he really didn't want to spend any more time trying to explain it to me. But basically, he said, if I would simply trust him to get on the Bitcoin network and accept the British kid's payment of 200 Bitcoins for the $100 value of the magic card, it would be great. I was almost convinced it would be okay until he added that I should also give him a couple of $1,000 to buy Bitcoin because it would make us, as he said, filthy, stinking rich one day. Of course, what mother in her right mind hands over $2,000 to a 12-year-old? So I ended up saying no to the whole deal. It just sounded weird, far-fetched, maybe illegal. So nope. I was a very stubborn parent. And that was the end of the Bitcoin conversation. And he ended up selling the magic card to an American kid who paid him $100. I know this is a shocking admission, but sometimes parents should listen to their kids. Sometimes kids are right. Consider this. If I had trusted my son and allowed him the $2,000 that day when Bitcoin was priced at 50 cents, today, at the time of this publication, with Bitcoin hovering around a price of $37,000, that $2,000 would be worth $148 million. If you want more information about us at Crypto Unite, please visit our website, bitbinge.training. And remember that the information we're bringing to you is basic. If you're interested in a deeper dive into any of the subjects we touch, always check out our resources page. Thanks so much for watching.